And then with psychology, when I learned that there was a toolkit called technical analysis that equipped you to get inside the head of other investors and understand fear and greed and emotions and all of that, I was totally hooked. People that have an awareness of who they are, what they're good at, and probably arguably 100 times more important, where their weaknesses are, their imperfections, I think are really, really important. The ones that know, I tend to do this kind of poorly. And so these are the structures that I've put in place to try to address that. Those are the guys where I leave there, I'm thinking they really are on the right side. I mean, they really understand who they are and how they're trying to do it. Pre-trading the day before you get to the day. That's beautiful. I'm going to use that and credit you for that, Mark. That's fantastic.
Welcome to the Alpha Mind podcast, where we focus on exploring the behavioural, psychological, emotional and mental aspects of trading and investment performance so you can become a better trader, investor, taker and manager of risk. In this week's episode, we are in conversation with David Keller. David is someone who comes with a huge dose of wisdom, know-how, knowledge and experience about how markets work and how people in markets work, function and think. David runs Sierra Alpha Research, a boutique investment research firm focused on managing risk through market awareness. He combines the strengths of technical analysis, behavioural finance and data visualization to identify investment opportunities and enrich relationships between advisors and clients. David is also Chief Market Strategist at StockCharts.com, where he helps investors minimise behaviour biases through technical analysis. Previous to that, David was a Managing Director of Research for Fidelity Investments in Boston, where he managed the technical research department as well as the legendary Fidelity chart room. I first met David a couple of years ago when he was president of the Chartered Market Technicians Association, and he was hosting their annual symposium in New York, where I was invited to be a speaker. He is also involved in technical analysis in other ways and is a member of the Technical Securities Analysts Association based in San Francisco, and IFTA, the International Federation of Technical Analysts, which also happens to be the parent organisation of the STA, who this series is produced in association with. You will really enjoy this podcast. We touch on many great themes, and I highly suggest you sitting all the way through this and stand to the end. You will be better off for it. Thank you very much. The Alpha Mind podcast is delighted to be associated with the Society of Technical Analysts, the world's oldest and one of the largest and mostly widely respected bodies which trains and accredits members of the investment and trading communities in the study of technical analysis. You can find out more about the STA on sta-uk.org. Now on with the podcast. Welcome to the podcast. If you'd like to introduce yourself and give our audience your backstory.
Absolutely. It's a pleasure to join you guys both. I've listened to your podcast. I think it's really, really well done. So I'm excited to be a part of it. So I've been in the financial industry for about 19 years. I had the very traditional course of study of music and psychology at university. From there, I somehow found my way to Bloomberg in New York City, and I was there for about 8 years. And somehow studying music and psychology were a great introduction into investing. And I think of it this way: one, the music side, if you're a musician, it's very mathematical. Actually, it's a mix of the creative side, but also a very mathematically oriented thing. So I think the statistical part of music and finances actually were kind of an interesting parallel. And then with psychology, when I learned that there was a toolkit called technical analysis that equipped you to get inside the head of other investors and understand fear and greed and emotions and all of that, I was totally hooked. And so that's what I studied at. I sort of learned technical analysis by working with clients, which were buy-side and sell-side firms across North and South America. And then in 2008, I was hired by Fidelity up in Boston and moved up there. And for about 8.5 years, I was a managing director of research at Fidelity. So I ran the technical research department. And we, altogether ran about $900 billion in equity mutual funds. And so my team would advise the portfolio managers on what stocks to buy or sell based on the charts, but also work with them on sort of behavioral biases and using technical analysis as a way to minimize the impact of behavioral challenges that I think most investors fall victim to. And then in 2016, I left there, launched my own firm called Sierra Alpha Research in 2017. And it was a mix of investment research, sort of technical research for institutional investors and advisors, but sort of evolved into being more of a coaching opportunity for financial advisors. So I would work with work with them and try to help formalize their investment process, try to address the behavioral biases both within their own investments, but also with their client interactions, and help them may have better communication with clients, make better investment decisions. And then about 6 months ago, I actually joined stockcharts.com in Seattle, Washington, Redmond, Washington, actually outside of Seattle, as their chief market strategist. So I'm continuing my own business on the side, but also working with them to help individual investors make better decisions. So that's my quick background.
Thank you for that introduction. So in terms of what we do at the Alpha Mind podcast, we like to talk to people very much about how can we help people deal with this psychological side of trading, with the performance side, with the behavior side. How can they become more focused, improve their self-management, their decision-making, how they turn up for work, how they present themselves. And I know that's very much part of what you do as well, part of your overall package. And it's fascinating that, you come from this area of music and psychology as well. Because I've noticed a lot of people that have come in from different fields, such as that, who have done really well in the markets. I heard a story of a portfolio manager at one fund, and she was a photographer. And, there's a very creative side to that. And I think creativity is really important in this job.
No, it's so true. And there's a book, I don't know if you guys know it, by Bennett Goodspeed, called The Dow Jones Averages. And it's a quick and easy read, but it sort of, compares some Taoist philosophy with investing in a lot of ways. But his big theme of that is whole-brained investing, and how you need to balance your left brain analytical side with your right brain creative side. And his, the premise of the book is that, especially on the institutional side, you have an analyst who's, very detail oriented, breaking down balance sheets, income statements, really getting into the weeds on companies. And that is the skill set you need as a fundamental analyst, right? Understanding all those details. But as a portfolio manager, you actually need a much more right brain orientation. You need to be thinking more big picture and relationships and themes and thematic shifts and how things are going to evolve. And you have to creatively think about where things might be headed and imagine emergency scenarios. And that is all more of a right brain activity. And a lot of people, I think on the institutional side, they're very analytical and very good at the details, but struggle to make that transition to be more right brain, more creative. So I think you're absolutely right. His premise is sort of what you suggested. I think you need a balance of having an awareness of the detail, but also, having an awareness of the big picture and what's happening around you. And the best investors I've known are the ones that balance those two sides pretty well.
Yeah, I think we've always spoken about the, kind of like the definition of technical analysis, where many people think it's more of a mathematical thing, a statistical thing, but in reality, we know that the creative side and the artistic side of technicals and the spatial analysis that is required for that is pretty important. And I guess the reality is that the ideal way of looking at technicals is to have some balance between those two themes of it's kind of, there's some mathematical origin, but if you don't have the creative edge to explore it, it being, the dynamics of the markets you're looking at, and the creative way you look for opportunity in the market, then you're not going to have as much edge as someone that is using, that sort of background art form philosophy to explore. And I think it's interesting that coming from a musical background. I mean, music. I remember my aunt always telling me it gives you this sort of sixth sense. It accesses this part of the brain that is kind of switched off for most people that are not music orientated. But if you can explore and build, the ability to read and play music, then it does give you an extra sense of perception that's more broadly usable in kind of like whatever you do in life.
It's funny. So when I was studying music at college, I was actually focusing on orchestral conducting. So, conducting an orchestra. And if you've done it before, if you've seen it done, what basically happens is you're standing in front of about 100 musicians, all playing different instruments, playing different parts. And you are basically, making eye contact with all of them, trying to communicate, get them to all communicate one emotional idea together, right? But then you have to glance down to a piece of music, and an orchestral score will have 15, 20 lines of music going across the page. And you, at it in an instant, have to look down at this piece of music and make a bunch of very quick assessments. You have to look for patterns. You have to, look at who is leading the musical phrase and who is, harmonizing around that. You have to think about, with your knowledge of music history, anticipate what's probably going to happen next based on the style of music and where you see things going. You have to look for things that are a little different, who's sort of an outlier versus other things. And what was so funny is the first time I looked at a price chart and saw a series of indicators along with price, it's like I had somehow been trained to do this all the time. And I've reminded my father many times, don't worry, my music degree was very well spent, money well spent, because it was a beautiful primer for this. But that's exactly what happens. You look down at a price chart and you're using your knowledge of market history to understand what type of stock this is, what probably would happen next if, sort of history repeats itself. You're looking for convergence and divergence of different patterns. You're looking at momentum, and you're looking at all these things. And so it somehow is a very similar skill set. But I think to your point of it being a balance of art and science, I think that's absolutely right. And if you know the history of financial analysis, technical analysis actually predates fundamental analysis in a number of ways. And the early, going back thousands of years, you have examples of people, tracking prices and trying to anticipate what's coming next based purely on the price of assets. But what you saw, Charles Dow in sort of the early 1900s, you had, technical analysis was really the quantitative analysis of the time. It was the way that you could statistically look at data and try to figure out what's going to happen next. And that was before companies in the US had to report any sort of fundamental data with any sort of consistency. And so what's happened since then is you've had a real swing of the pendulum in the financial industry toward much more statistical forms of analysis, this growth of quantitative investing and, being so deep into models and the statistics of what's happening. But I think to your point, there's a danger if you become too focused on the artistic side of it and you don't really understand the data. But it's equally a problem if you become too focused on the data and models, and you forget that these are actually humans making decisions that are driving some of this data. And what happens is I've seen people create models that are so unrealistic, they no longer actually represent reality. And so I think, it's not man or machine, it's sort of man plus machine in the middle. And I think it's being thoughtful about how you use data and how you understand statistics, but also how you connect it to behavior and fear and greed and decision making. And I think that middle ground, I think, is what you guys have explored so well on the show before.
Yeah, no, thanks for that. I was going to say that, keeping it simple is a massively important philosophy as well. I do take your point that there are a lot of people that if their sort of process behind analysis isn't working, they'll dig deeper into where the answer might be. And I guess I remember some guy once I used to know. He had so many lines on his technical papers and so many indicators that are popping up with all sorts of signals that in the end he never had a signal because it's just like there was just so much stuff. And and I know some guys from the commodity space, and one guy that was immensely successful, kept it to pure and simple bar chart and almost nothing else, but he just got that sense of feel, that intuition from next potential move coming from just a very, very broad observation of what's gone on in the past, what shapes work more best for what product, and just having a very good memory for understanding that what happened then is likely to what's to come next. Yeah, very, very successful, but kept it simple.
I've gone through that journey myself when I was a trader. I would get into there would be periods where I was struggling to see anything in the market, and I would go deeper and deeper into my analysis. So I'd have the price chart, and then I'd always have RSI on there, but then I'd start doing MACD, and then I'd do stochastics, and I'd do ADX, and and then I'd do lines everywhere, and then I'd try to create my own indicator of an indicator. And then, this went on for weeks and months, and I completely lost myself in this analysis. And I'd end up with analysis paralysis where I wasn't doing anything, and then I and this has probably happened 2 or 3 times in my career, and I then remember thinking, what the hell am I doing? You know, all, all these indicators are more or less the same, slightly different ways of analyzing the speed of the price change. So they're not going to give me any more. So I went back to eradicating all of them and just look at, and I always did best when I just looked at price and I said, what is that telling me? What am I seeing here? You know, you let the market talk to you. And that was always, and that's interesting because I think that's almost what you were saying with the music before. You look at music and you let the music talk to you.
Mm.
It's the same with markets.
So it's so funny. Early in my career, my job was to go to the trading floors in New York and Connecticut, sort of the big trading floors, equity FX trading floors, and work with the traders. And I was a technical analyst at Bloomberg. So my job was to just work with each of the traders, help them incorporate technical analysis into their trading, how to connect what they're seeing in the charts with their order flow and everything. And I remember walking on the one FX desk, and I walked past this one guy's terminal, and he had just a cockpit of all probably 8 monitors. And I looked, and he probably had 70 or 80 different technical indicators up on his screen at the same time. And I stood there for a couple minutes just kind of watching him, and I'm thinking, this is unbelievable. Like, this guy is consuming so much information. This is unreal. So I went and I tapped him on the shoulder and I shook his hand. I'm like, hi, I'm Dave Keller. I'm a technical analyst. I have to tell you, this is unreal. I can't believe how you're doing this. Can you just, tell me a little bit about how you're using all this? And he said, yeah, I have absolutely no idea what any of that stuff means. He said, but the head of the desk will walk by and will look at my dashboard and say, boy, that guy's all over the markets. Look at that stuff. So I feel like if you want to overcomplicate things, charts will give you a way to do that. You can create so much complexity with it. I think what's probably saved me over my career is I've always worked with people who are not technically oriented necessarily. I've worked with a lot of fundamentally oriented money managers and analysts and salespeople. So as a result, I've never been able to make it so complex that I can't explain it to someone who's unfamiliar with it. And I think that need to keep justifying. You have to simplify because it's something that you're going to use to communicate an idea, which means it has to be digestible and accessible to people. So for me, I've always simplified, and probably it's one of the better things that's happened because it's kept me very, very simple in terms of my analysis. And I think you guys are right on that.
I've always wondered about that side of it. I mean, I was never an investment advisor, so I never had clients. I was always dealing directly in the market, and it was always difficult for me to have to explain sometimes to, say, a head of trading or a risk manager why I'm holding certain positions or have certain market views. Because I may be all in using a lot of, 100% VAR or even more if they could let me. And the head of trading or the head of risk would walk over and say, Steve, what's, why have you got this view on, it's a hell of a lot you've got on there. What's driving it? And I couldn't say, just broken out of a cup and handle pattern and and momentum on the charts. You couldn't say that because he's just going to look at you and go, what the, a cup of tea pattern. He's got no idea. So you then had to give him the actual narrative. Oh, bonds are doing this and the US stock market's doing this. And, it means that. So you had to explain that, and there was always a danger in that because I didn't really believe that. So
right.
it must be really challenging for analysts who are working with clients to recommend something based on a technical pattern, or maybe they have to learn to craft their language, or how does that work?
I was going to say, so I think it's a little of both, right? I think part of it was using tools that you can readily explain, and that's why something, like GAN analysis or something comes to mind as something that's a little more esoteric. And so it would be very difficult to explain that to someone who's not, very familiar with the work. So I've tended to keep things that are relatively simple. Things like moving averages are pretty easy to justify and explain. You're taking the noise out of the way and trying to smooth out the trends. I would say that the growth in, quantitative analysis, I mean, there are so many studies now talking about the momentum factor and explaining why price has information. And that's something that I think technical analysts knew for the longest time, but couldn't really prove. And now you can say, yes, I'm betting on price momentum. Here's a bunch of papers that tell you why that kind of works. I think that's made it a lot easier. But I would also say it's about the language, and it starts very simple. So instead of talking about something being overbought or oversold, we would always talk about something being rich or cheap. And that would be the beginning of that sort of, reframing the chart as being a visual representation of a behavioral phenomenon. So we would always tie it back to the investor behavior that's causing things to happen, right? So prices aren't driven on fundamentals, they're based on people's expectations of how the fundamentals are going to change. And we're trying to quantify how those expectations are evolving. And when this chart looks like this, it tells us that the stock is trading cheap and that people are going to get interested. And this inflection point tells us that there's accumulation, telling you that people are starting to buy into it. And so it was just explaining more the behavioral or the supply and demand that would actually cause the price trends to emerge. So it's just a question of reframing it, but it was a way that would make sense to people who are less technically oriented.
Yeah. I found it very useful to use, Elliott Wave type principles, Fibonacci type principles, and talk about the market in waves and adjustment waves and wave extensions. As I think you needed a bit more work to sort of understand those stories in the market. But actually, when you talk about retracements and target zones and buy zones as a consequence of that, and then breaking through and extensions and Fibonacci extensions and the third wave extension in Elliott Wave, all of those things actually become quite a nice story. And actually, when I was on the sales side, I was a broker, so one had to concoct strategy and work out opportunity from broad observation of the market. And of course, you couldn't just say, I think it's a buy. Well, you could, but you needed to be a bit more colourful about it. And I found Elliott and Fibonacci just a very good way of framing it appropriately for a trader to understand kind of like the sequence of the market.
Elliott Wave is a perfect example of how you can approach things more from a way that I think people will resonate with people in a way that might not. So there are two ways I think you could portray the Elliott Wave phenomenon. And if you're not familiar, it's just the idea that the market moves in a wave-like pattern as an impulse and then a correction. And anyone that's traded anything, that wave-like movement of prices. But way one I could explain to you is there is this magical phenomenon where there is a mythical relationship mathematically between different movements. And when something moves in one leg, it's going to move 61.8% the other way before it moves 38.2% higher. I might have lost anyone that does not buy into that immediately. However, if I tell you, look, once a market is completely sold off, there's going to be early buyers and there's going to be an early accumulation from the smart money. That's going to cause an initial move up. Then there's going to be a pullback, and that makes a higher low when people are kind of in a state of disbelief. But then there's a big push higher when sort of everyone agrees, yes, this thing's going to work. And that's what creates this extended third wave when people really start to accumulate. And when you start describing the behavior of what's causing those waves, it makes perfect sense to anyone that's traded because you've seen that happen. You've seen people buy too late, sell too early, be on the wrong side of things, and how they panic and reverse course. So those are describing the same wave patterns, but in two different ways. And I've always found that behavioral angle to resonate with more people, especially people that are not sort of visually technically oriented.
Yeah.
I've got an interesting view on that, which is when I coach traders, I do a psychometric analysis on them, and I use a particular tool called the risk type compass, which it categorizes people into various different risk types, different risk personalities. And it's only a theory because I don't have enough data on it, but I've noticed certain risk types seeming to trade different parts of the Elliott Wave. So we have more creative risk types. We would call them more daring, more adventurous. And they're usually people that are also very artistic, because I use another psychometric as well, which categorizes them into different forms. And I've noticed these are always wave one guys. They're always in the first part of the move. And it's like they see the move happening before anyone else. And they'll also be wave A's. They'll be the guys seeing the big correction before it comes. And sometimes they get in too early, which is almost their big they're big risk. But when they get it right, they're getting a move that nobody else is in on. So they'll make a lot of money in a very quick space of time. The problem, of course, is when they're wrong, the previous move carries on extending, and it can cost them a lot of money in that way. And then we then have the other side, almost opposite to them, is we have people who are more. I'm trying to think about it. They need more evidence. They need more. They need a lot of evidence. They can't go in with just a few clues. So they need a lot of. They need to tick a lot of boxes before they'll join the market. And of course, one of them is that the move is well advanced, and the evidence for that move is now starting to. The fundamental factors can be explained, and they're comfortable going in. So these people are usually wave 3 and quite often wave 5 guys. It's just really interesting. We keep seeing this. I'd love to do this. I'd love to actually analyze this and do some research on it. God knows how you would do that. But it is almost just anecdotally, I've noticed this over the years.
Well, it sounds like a formula for creating a hedge fund to me.
Yeah.
It was born here on this podcast.
Go on ahead.
We will return to the podcast shortly, but first we want to tell you about our association with the Society of Technical Analysts. The STA are one of the world's leading bodies for training and educating investment specialists and traders. The STA run distance learning programs and diplomas in technical analysis. They also run accredited diploma programs at such prestigious academic institutions as Queen Mary University of London, King's College, and the London School of Economics. To find out more about the Society of Technical Analysts, please visit their page, sta-uk.org. Now back to the podcast.
No, I think there's definitely something to that. I think, I saw a similar sort of thing with, just working with a lot of growth managers versus value managers in terms of big money managers. There's a different, mental an orientation to the markets and when they would feel comfortable taking on a position. And a deep value guy versus a growth manager, they're playing a completely different game, and they're wired differently. The way they approach their day is different. The way they think about opportunities is very different. So I think what you're doing is actually fantastic, putting some behavioral studying behind that and seeing, and I think what I love about what you described is you're helping people get inside their own head, to really understand how they're making decisions, which I think is fantastic. That's a great idea.
Yeah, but it's amazing because when we see people doing a job that's not suited to them or doing it in a style that's not suited to them, they're often struggling. And usually what's happened is they've learnt from somebody else who's a different personality. So that particular method or style works really well for one person, but then that person's mentoring somebody else, a trader or investor, who's got a different personality, and it doesn't suit them. But they think this is the right way to do it because they've seen it work for somebody that they respect a lot.
That's right. It reminds me, I did a lot of hiring at a large buy-side institution, and whenever people ask me, and if any of your listeners are trying to get into the financial industry or thinking about doing that professionally, and when I'm asked how they should approach it, I always tell them the most important thing you can decide is if you are more of a buy-side person or more of a sell-side person, because and the way I sort of describe it is from what the time I've spent on both sides of it, being a sell-side analyst, broadly speaking, generalizing completely, you will make yourself look better by making the people around you look less good, right? You sort of move yourself up by pushing down on the people around you. But on the buy side, again, generally speaking, you do better if you lift the people around you up along with you, and you do better if the group does better. And that's not to say that either one of those are right or wrong or good or bad. I think there are, it's more of making sure that your personality and what brings you joy and brings you fulfillment is in line with where you're at. And I've seen people that are more competitive, more trying to pursue more of a sell-side orientation, but they're in a buy-side environment where they just destroy relationships all around them. And then you see people who would be much better in a team-oriented, fulfillment of a buy-side orientation, and they're in a competitive side of the market where they're just going to get drowned out. So making sure that you pick a direction that's in line with your own personality and what brings you joy and brings you happiness, brings you fulfillment, I think is so, so important to, because I've seen too many people like you probably have that are, probably just not in the right spot. It's so obvious and it's too late for them to really get out of it.
One of the questions I wanted to ask you was, and again, you've mentioned here that there's lots of different games going on here. Different people trading different products, different ways, buy side, sell side, stocks, bonds, value investors, growth investors. There isn't one type of best, but is there any commonalities that you see across all of them that you feel are aspects that people need to get their head around and need to get right?
Hmm. Oh, really good question. Boy, so many ways that I could answer that. I mean, I think the number one thing that I would say is the people that I've seen in any of those places that have been the most successful, there are some common themes. One is they have a great self-awareness, and you kind of spoke to this when you talked about, doing a behavioral study, thinking about how your brain is wired, how you make decisions, and then, using that to understand how you're trading or how you're going to be able to trade well. I think that's important. And so people that have an awareness of who they are, what they're good at, and probably arguably 100 times more important, where their weaknesses are, their imperfections, I think are really, really important. The ones that know, I tend to do this kind of poorly. And so these are the structures that I've put in place to try to address that. Those are the guys where I leave there, I'm thinking they really are on the right side. I mean, they really understand who they are and how they're trying to do it. I would say the second thing is just good routines. So the people that I've seen that are unsuccessful are ones that are sort of, throwing things around and seeing what sticks and doing a lot of hit or miss, a lot of just testing the waters, and there's not enough consistency to what they're doing. The people that I've met that are really consistently performing at a high level are ones that have a good routine. And so I always coach investors or, financial advisors, what I always talk about your morning coffee routine, right? When you sit down, you fire up your computer, you get ready, you get your cup of coffee. What do you look at? And a common mistake I see people make is not looking at the right information first. So I see long-term investors that do things like flick on financial media or look at their portfolio and see what it's doing right now, or, anything that I would describe as looking at the flickering ticks of the market. And if you're a long-term investor, those are all things that should be at the end of your process. The first thing you should be looking at is a long-term trend. So for me, the first thing I look at is a 5-year weekly chart of the S&P 500, and it's showing me the long-term trend in stocks. So as a long-term investor, every morning I'm reminding myself that the primary trend is up. We are making new highs. So everything that I do beyond that moment from the beginning of the day is remembering the fact that we are in an uptrend. And until I get evidence that tells me otherwise, I have to be approaching my role that way. So it's having a routine that is in line with your investment horizon, how you're trying to win the game. So those are commonalities. I think having a good self-awareness and having good routines, if everyone did that, I think they would be in a much better place, or certainly feel a lot better about their investment process.
Yeah, I think there's this process about sort of routine approaching the market, for example, starts, of course, as to how you end the previous day, how you rest, how you retire, how you sleep, how you wake up, how you interact when you wake up, and that can be how you're not grabbing your iPhone when you wake up, but you're kind of just accessing the world around you as you wake up, and using the journey to work to tune in to your senses, and not sort of pre-trading the day before you get to the day, and you know what I mean, and not feeling that you've got this stress and the strain. It's almost like you need to come to the day as kind of like you're set and you're primed and you're aware, and the green light of, okay, you're now in a position to now watch the market. The green light comes on. Now, if you've not sorted your mind out beforehand, if you've not come at that in a way that you've balanced yourself, because you may well come with the baggage from yesterday and the difficult night's sleep and the frustration about maybe not just making money per se, and then you hit the market, you're going to make bad decisions. You're going to make decisions where you're going to jump onto the wrong trade. You're going to not have the capacity to look at a market with great depth and with creativity, because if you've got a stressed mind, those elements of your thinking are offline. And so the whole concept of how you retire, how you go to bed, how you wake up, how you approach the journey to even get into work to then, or desktop, to then say, I'm now in my trader mode, you can get that badly, badly wrong.
I absolutely love that. And your quote, pre-trading the day before you get to the day. That's beautiful. I'm going to use that and credit you for that, Mark. That's fantastic. But I think you're right. When I talk about the morning coffee routine, I'm making assumptions about what you're doing before you turn your computer on. I think you are absolutely right. So, and again, I think people need to develop their own routine there that's going to help, get them in the right place. I mean, so for me, it's writing in a journal, it's prayer, and it's meditation. And the days when I don't do those three things, my days are not as successful for a lot of reasons. And probably the main reason is because mentally I'm not where I know I need to be successful there. And for me, in the journal, that's sort of a common theme. If there's another one, part of self-awareness. I read a book, The Artist's Way, by Julia Cameron years ago, and it's a book all about unleashing creativity, and it's really designed for artists and musicians and things to sort of get all of your mental baggage out of the way so you can be creative. But there's another book called The Artist's Way at Work that sort of relates that thinking of unleashing creativity to your work environment. And their first recommendation, a part of this growth process or this healing process, I guess, is to write 3 pages every day. And it's just open the notebook and fill 3 pages with whatever you can. And the days when I do that first thing as early as possible, it's just fantastic. And page 1 is usually a bunch of just stuff. And page 2 is where it gets kind of old. And then magical things happen about the end of page 2 into page 3, where all of a sudden you really start getting to things that are deep and meaningful, good ideas, creative impulses that kind of come out. And you realize you've swept the floor and now you're actually ready to be there. And so that process for me, and again, I'd encourage everyone to be thinking about what are those steps you can take before you start your day as a trader. And I think that's so important.
There's something which you both touched on there, and I'm taken back. I'm going back now to an interview we did last year with Brett Steenbarger, who I'm sure you must have heard of, a fantastic market psychologist. And he talked about spirituality and ego, and that was really the thrust of what was a fantastic conversation. And I'm hearing you talk about before you start your day, you do some, was it prayer, meditation? There was something before that. Was that journaling?
Journaling.
And I'm a huge fan and a huge believer in we look at all the big religions, they all have this structure of prayer and meditation, and it's almost like it's about realizing that you're not the center of the world, that there's something much bigger than you, and it kind of allows you to know your place. You're not the most important thing. There's more important things for you. And I always see this with great traders. They're not at the center of their world. I've talked about some of the phenomenal traders that I've coached almost have this ability to step out of themselves and see what they're doing and then check themselves. It's almost like, and then go back into themselves and they said, yeah, no, that's wrong. We're stopping that now. And there's a humbleness about them. There's this almost mythical idea of the trader being the big, we use the big swinging dick is the term. The big ego, the big I am. Was it the top banana was one phrase we used to use. And yet the really great traders I've met and great investors I've met have almost been the antipathy of that. Incredibly humble, incredibly grounded, incredibly down to earth. They don't put themselves at the center of their world. And that comes back to something about you said, ritual, meditation, prayer. Mark, you always talk about mindfulness, and it is such a.
Well, I think it's important, right? It's just the ability to just use the little pauses and micro moments of the day to just, as we constantly say, to reset, refresh, and recalibrate yourself. Because if you're not doing that, then you just get dragged into these moments of, I guess, to some extent, fear. It can stop you seeing things. It can stop you seeing. It certainly can stop you earning alpha, and it's just critical. I mean, you just can't work full day, 10-hour days, 6,000 reps without these mental breaks. Can't do it. We can try to do it, but the wheels will fall off at some point.
No,
So,
I always tell people there's a reason why any 12-step program, the first step is to admit you have a problem
Yeah,
and
yeah.
recognize that there's an issue, because unless you can admit that to yourself, then none of the other steps are going to do anything. And so you had mentioned sort of the humility, I think, that you need to have if you want to improve yourself as an investor, as a trader. You first have to recognize that you don't have all the answers, that you're imperfect, and that imperfection is okay. There's a bravado, there's an overconfidence that naturally comes with investing, especially institutional investing. But as you said, the guys that I know that I respect and I think have done the best over the long term consistently and have not flamed out are the ones that have a humility. They have an honest conversation with themselves about what they can do to get better, and they're looking for ways to improve. And you can only do that when you have the ability to admit